Could you tell us in 2 minutes what your presentation just now was about?
Yeah, I think there's a revolution going on in the field of indexation, and a lot of the indexing world has been built on a foundation of capitalization weighting, which in turn is predicated on the notion that prices are correct, that all prices are fair, that markets are efficient. If markets are inefficient and some prices are too high and some too low, in any sort of remotely systematic way, there are better ways to index. And we were pioneers, I think it's fair to say, in one of those areas, the area of fundamental indexation. And it seems to have spawned a revolution. We're seeing equal weighting, which has been around for 20 years, minimum variance strategies, which have been around for 20 years, finally starting to get traction now that non-cap weighting is becoming accepted. We're seeing new ideas along the lines of risk efficient or maximum diversification gaining traction. So this presentation was focused in part on a compare and contrast. And what's interesting is they all work. They all add value relative to the market, which basically means that the market, by putting most of our money in the most popular, trendy, and comfortable companies, can be beat by disciplined approaches that take us away from that bias.
Do you reckon the market in the future will be thus stable that your new market weighting will also work in this way?
I think the nature of market inefficiencies is stable in one regard, and that is that human beings chase fads, and whatever is popular is likely to be priced to give us less reward, because you don't need as much reward if you're buying something popular. And so a profitable strategy would be one that tends to be contrarian. It won't win all the time, not every quarter, not every year, but over long periods of time I think it will tend to add value long into the future.
At this point, a tenth of a percent of the whole market uses your strategy. What if the whole market will start using your strategy? Will that also add value if you still use it?
Well, of course, if everyone uses any strategy, that strategy becomes the market, and any opportunity to add value disappears. Firstly, that won't happen. Secondly, the moves in that direction are very slow, very gradual. And thirdly, the early adopters of the idea benefit as the idea gains popularity. And so I think for now, that's not a serious concern. I think 10 years from now, it's something worth revisiting.
And in 10 years' time, you will have a new strategy developed, which will...
We're constantly working on new ideas. I think the extension of fundamental index into the bond arena is very interesting. I think asset liability mismatch is an area of deep interest to us and should be of deep interest to the marketplace. And broadly, I think we're in an environment of lower forward-looking rates of return, where if markets are priced to give us 4 or 5% for the long-term investor, adding a couple of percent suddenly becomes enormously important in achieving our long-term goals.
Can you tell us a little bit more about the cap weighting, the differences that you talked about just now?
Well, of course, capitalization weighting weights companies in accordance with shares outstanding times the price, which means the more expensive the company, the more you're going to put into it. So it winds up being growth tilted, favoring companies at high multiples, momentum chasing, pursuing companies that are rising in price, and popularity weighted heavily towards the companies that are most popular. Why should we expect a full equity risk premium for investing in that fashion? Now, fundamental index simply seeks to mirror the look and composition of the broad macroeconomy, weighting companies according to their economic footprint. How big is their business? And there's a lot of measures of a company's size: sales, profits, book value, dividends. These are all relevant measures. So by using multiple measures of a company's size, you can mirror the look and composition of the economy instead of the look and composition of the market. What does that do for you? It means that you're moving money out of the most popular, trendy, and comfortable companies and moving money into out of favor companies that are often priced to offer superior forward-looking returns. We think it's a much more valuable, much more sensible way to construct a portfolio.
Do you reckon there's a specific type of weighting that will gain the most traction?
I think cap weighting will be dominant for as long as I'm alive. I think fundamental index will continue to be the second most popular and most significant source of value add for those in the indexing community in the years ahead.
Thank you very much, Mr. Irwin.
Thank you for your time. Appreciate it.